Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. Today, we are joined by Sean O'Dowd of Scholastic Capital. Sean's going to share his story investing in single-family real estate with his now wife, and turning that idea and concept into a full-on fund with a partner at Scholastic Capital. Their model consists of buying single-family homes in high-level school districts and renting them on longer-term leases. Now let's welcome Sean O'Dowd. All right, we got Sean O'Dowd with Scholastic Capital joining the Westside Investors Network podcast today. Sean, thanks for taking the time to talk with us.
Thanks for having me. I'm excited for this.
So Sean has a very interesting business model, which we will hear more about later on in our conversation. Scholastic Capital, his company, buys single-family houses in great school districts and rents them out long-term. Again, we will get more into the details on that here shortly, but I want to hear about Sean O'Dowd. And did you start off in real estate straight out of college? Did you have a different career that led you to real estate? Who is Sean O'Dowd?
Yeah, so I did have a different career when I got out of college, although real estate was kind of a when, not if situation. So I moved 22 times before I went to college. So that was my initial exposure to real estate. It was, finding a new place to live is this super fun thing that my family was doing every 8-9 months. So I got super into it and super interested in real estate because of that. But right out of school, I went to a business school for college. And I worked for a consulting firm right out of school before getting back into real estate.
And how long did you do consulting before getting back into real estate?
I was with a big firm for 2 years, and then I was independent for about 2.5 years. So I was doing the consulting for about 4 or 5 years, although I was buying real estate on the side with the money I was making for my job.
Very nice. And a lot of people, you might be in the same boat, but they start buying real estate while they're working. And typically they're buying single family homes or small multifamily. What were you adding to your portfolio during that time?
So I did 2 different things. I was buying them with my now wife, actually. We bought our first property together before we were engaged, which probably was not the smartest thing in the world in case it didn't work out, but we did do that together. We bought 2 small multifamilies, and then we bought 3 single family houses. 2 very different strategies, and the goal was to kind of test and try both of them. And we really didn't like the multifamily strategy, and we ended up really liking the single family strategy.
Very nice. And tell me a little bit more about Scholastic Capital. What is Scholastic, and where does the name come from? Because I'm curious. And 2, what do you guys focus on?
Yeah, so the name comes from my partner actually came up with the name, and a gentleman named Michael, he's in the GP with me. And he came up with the name. And the reason why it's Scholastic Capital is we're intentionally buying homes only in really high-end school district areas. There's a bunch of reasons why, but it's a really core part to our thesis is we only buy in those specific neighborhoods. And for that reason, we figured we might as well go with the Scholastic Capital name for the school district tie.
I love it. And how many deals do you guys have in your current portfolio?
We've got 21 homes. It's about $11.5 million for the real estate worth, and we're buying about 4 to 5 homes a month right now. So we just started buying under the fund model about 4, 5, 6 months ago, and we're scaling up pretty quickly.
Very nice. So today, the deal that we're going to focus on is one from a couple years ago. I do want to touch on some of your more recent stuff here in a little bit, but you mentioned that you had a deal from a couple years ago that you purchased with this idea and this concept and this model, located in Illinois. Tell me about this one.
Yep. So this was one of the first deals that my wife and I personally bought to kind of test this thesis. It's now part of the fund. So this deal, it's a single family home in a really high-end school district in Illinois. We bought it for $440,000, 3-bed, 3-bath, 1,900 square feet.
Very nice. And how did you purchase this deal?
So this was MLS. So we bought it off the MLS because we only buy in really good school districts, and because we were buying homes with the intention of trying to sell them to a larger institution down the line. There's not a lot of neighborhoods we can buy in, and there's a lot of very specific things that we're looking for in each house, which means when we see something on the market and it actually passes all the filters, we tend to know immediately. So this home hit the MLS, and I was in the living room like 30 minutes later. We were under contract probably 2-3 hours after that.
And what is your criteria other than high-end school districts?
So within the like where we want to buy, there's a bunch of different things, but at its core, it's like we want really good school districts. That's our demand driver. There's a bunch of data as to what we're doing that. On the supply side, we're only buying homes in areas where the owner occupancy rate is 80, 85, 90% or higher. In the country, it's around 60, 65%. And we're doing that intentionally because then we're going to be sitting in a supply-demand imbalance. A lot of people want to get in there. Not a lot of rentals available. We're the only game in town. If you want the good school district, we can take a higher price premium as a result. And then we're only buying in the upper Midwest because we think that's going to have the best chance of institutional exit. That's on where we're buying. On the home specific side of things, we've got like 17, 18 different criteria that we're looking for. Got to be at least 3 bedrooms, got to be at least 1.5 bath, smaller than 3,000 square feet, above 1,000 square feet, the kind of standard ones. On top of that, speed limit, it's got to be on a street where the speed limit is 25 miles an hour or less. Can't have solar panels on the house, no pools at the house, things like that that we need to keep in mind, because if we break those rules, we won't be able to sell that home to a larger institution down the line.
Very interesting. I didn't know that. So, I mean, clearly you guys have thought about the criteria and have found, plenty of deals within that criteria. You said that you only focus on the upper Midwest. Are you in Illinois only, or are you in all the different upper Midwest states?
So we own homes right now in Wisconsin, Illinois, and Indiana, and we're actively looking in Minnesota and Michigan as well. So that's going to be our bread and butter. We may expand to Ohio, we may expand to Pennsylvania, but those are our core 5 states that basically hugging the Great Lakes.
And where are you located at? Where's your company located at?
We're in the Chicago suburbs.
Okay. So you're familiar with the area, obviously. When it comes to identifying these upper end school districts that aren't, right by you, how are you going about finding these different neighborhoods?
There's a bunch of data. So there's some things that like we have to use. So like Great Schools, for example, which is the one that ranks schools out of 10 and like integrates with Zillow. Like we have to look at that one because we're renting the homes on Zillow, so it needs to be good there. But we found a bunch of other data sets. For example, the one that's best is we have a data set that shows what % of the high school graduating class goes to Harvard, MIT, or Stanford. And that, there's a certain percentage threshold, or if you have above a certain % of the graduating class going to those 3 schools, it means like a lot of the kids in that school district are going to really great colleges. And that's a big driver of rental values. I mean, most of our tenants move in when their eldest child is 14, because they're about to start high school. The parents want the kids to go to a good high school, so they go to a good college. If the college list is matching where like what parents want their kids to be going through, then there's this much more significant rental premium bump that comes out from there.
Very interesting. Now let's talk about, obviously we've heard your criteria. We know that you're buying in good school districts. When it comes to the ultimate return of this property, first question I have is, how long is your typical lease when you do acquire a new property? And second question is, how long does it take to get leased out after acquisition?
Yep. So our average lease right now is 27 months. So call it 2.5 years, 2 years and change is our standard lease. Regarding time to lease, it's been variable, but on average, it goes pretty quickly. Like the fastest we've ever leased a home is literally an hour. where somebody really wanted to live in the school district. We were the only game in town. Like they didn't even see it. They're just like done, signed up, $4,500 a month. Great. We've had some homes that take 6 weeks or so because we misjudged on whether or not that was the right home for us to buy. And like we made a mistake in the underwriting. So it's a big range. On average, I'll have to pull the exact number, but I would guess a week to 2 weeks is our average leasing time right now.
And then typically, in I guess $4,500 a month is a pretty good rental rate, especially in the Midwest. I hear 4,500, I think in New York, Miami, and LA or San Francisco. How do you identify, I guess, the rental rate that you're going to be able to charge? Because again, I think in Midwest, and I don't think $4,500 a month for a 3-bedroom house. So how are you able to find those deals that are going to rent for $4,500 a month?
That's the hardest challenge for us, and why the underwriting is hard. We aren't batting 1,000 on the underwriting because you can't use like a rentometer or a rentcast in these areas because those are looking at comps in the area to get a rental estimate. If we're intentionally buying in areas that are 90+% owner occupied, it means there are no rental comps in the area. So it's really hard to kind of judge. What we have to do is we have to, for lack of better words, like stretch the existing comps that we do have to get the most possible data from them. For example, if you go on Zillow and look at rental homes, you can see the number of days the home's been on the market, the number of contacts per day, and the number of contacts, the number of applications. And we have a full-time team member overseas who is literally scraping that data manually every day, because we can look at it and be like, okay, this home was listed at $3,500. It's been on the market 3 days. It's had 75 people contact them and 12 applications. Like that home's probably underpriced if you've got that many applications and contacts in a day or two. Or like inversely, if it's been on the market for a month and nobody's contacted, like this home's probably overpriced. So we're collecting that data, and that is a big part of our rental underwriting process.
And do you guys have specific KPIs or metrics that you're tracking on, I guess, target number of views and contacts and applications per day or per week?
We do have thresholds. They differ depending on zip code, because some zip codes are bigger than others, where there's more houses. So we would want to see higher contact numbers per day for a bigger zip code versus a smaller one. But like a pretty good benchmark is like you want to be around 5. Like 5 contacts per day is like, okay, there's pretty significant demand. And if you assume a funnel of like 5 people contact, 1 to 2 end up going on a tour, and then of the people that tour, maybe 25 to 30% submit an application that's good enough to be accepted, then it's like, okay, we can kind of back out a funnel of like what we need from a contacts perspective to on a daily basis over, say, 10 to 20 day period to get the home leased up.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. And I know, like in our market here in the Portland metro area in Oregon, we definitely have, and we have an in-house property management company. So I'm pretty familiar with the daily, views and contacts and inquiries and all that stuff. For us, we have, once you get over $3,000 a month for a house, typically that lead flow is going to drop. Do you find in your markets where maybe if it's under $4,000 a month or under $3,500 a month, you're seeing that, or where's your threshold at when it comes to price per month on your rental rates?
It's pretty different by zip code. Our average right now, our average rent is a touch under $3,600 a month. We've got some that are well north of $4,000, and we've got some that are hovering around that $3,000 mark, depending on zip code. What the biggest driver for us has been just the number of other listings in town. Like once you get above like 3 listings in town, it's harder to kind of take price at whatever number we want. When we're the only game in town, it's a lot easier to push the price because we're the only rental available at that point.
Yeah, that makes sense. All right, now back to this deal in Illinois. Obviously, 3-bedroom, rented for, you said $4,500 a month.
So this one was $3,500. The $4,500 was the one that rented very quickly.
Okay.
This was $3,500. Yeah.
So $3,500 a month, or you said average 27-month lease.
Mm-hmm.
Do you remember what this lease started at?
This one was a 3-year lease.
Okay. Do you have like annual rent increases worked into your leases then? Okay.
We do have annual rent increases. This one's $100 a month. What we found is if you do it at like $100 a month, tenants are like, okay, that like I can understand it. If you try to do like 3% annual rent escalators, then the numbers don't perfectly tie, and the tenants are like, why is my rent $3,612 or whatever it might be?
Yeah, okay. And then in terms of management and operating these deals, we're going to use this one in particular because we're talking about it.
Mm-hmm.
Do you have in-house property management for your portfolio?
We use a third-party property management company.
And is your third-party management company available in all the different areas that you are currently in, or do you have multiple different property managers?
So they are available in all of the different areas that we're in. They're a national company.
Okay, very nice. Also very easy for you guys.
Makes it very easy.
So talking about the metrics, $3,500 a month, you have a third-party management company. What does typical maintenance and expenses look like for your deals in the single family portfolio that you have?
So we have a matrix that we use, and we got this from one of our advisors. But on one axis of the matrix, it has the decade that the home was built, the vintage, and then on the other axis of the matrix, it's got the square footage of the home. So we can say, hey, for a 1980s 2,000 square foot home, we're going to expect this. For a 2010 1,000 square foot home, we're going to expect this because it's just going to be a very different maintenance amount. On average, right now for our portfolio, it's around $260 per home per month of maintenance is what we're escrowing. It works out to be a little over $3,000 a year per home. Is for a 17,060 square foot home. That's about what we're budgeting and what we're seeing across historical spend.
Okay. And then for this Illinois deal, obviously you had to underwrite it. What were you projecting in terms of rental rates and I guess expense ratios, or just I guess overall NOI for this deal?
So we were underwriting around $3,500 a month on rent. So it ended up landing about what we expected. Our agents thought we were nuts because there was no comps. So they're like, we think it's going to be like 2,600 because that was the only comp. We're like, no, we think we're going to get 35. So underwrote at 35. Expense ratio we had at 35% as well. It's 35 and 35. And that's largely tracked out to where it should out to be.
Very nice. And so you bought this off the MLS. Did you pay cash for it or was it financed?
We did finance the home. We did 35% down payment. It was 35, 35, 35, which makes it very easy to remember. But it was 35% down payment, 65% LTV, and we exclusively use 30-year fixed debt. A lot of other SFR funds try to get a little bit more creative and get a little more aggressive in their debt, but we exclusively use the 30-year fixed.
And what were you projecting to cash flow on a monthly and annual basis for this one?
So for us, the threshold is 6.5 unlevered yield on cost is what we're looking for when we buy it. This one ended up being a little bit higher. We were at almost double digits unlevered yield on cost for the first 2 years. If you base it off of actual expenses, we were still escrowing for, if you escrow for actual maintenance that hasn't happened but will happen, it was mid sevens.
Okay. And is that pretty typical across your portfolio?
That's about right. Like we want to shoot for that 6.5 unlevered yield on cost is the real kind of magic number we're looking for. So this one was a particularly good one. I think driven by the fact that the maintenance incident rate has been relatively low, but that's exactly that number of like 6.5 is the kind of the magic number for us.
And then how long do you anticipate holding a deal, or I guess this deal? I'll ask you another question here in a second.
We're going to hold it until we sell everything as a portfolio. If we do, we we believe strongly we'll get more value for the portfolio, the more homes that are in it. So we don't want to sell homes one off unless there's a situation where like a home burns down and we decide to sell the lot off instead of rebuilding the house.
And I guess that leads me to my other question of being a fund model. You're able to do this because you have all these different assets that are owned by the fund. And so your investors can, get into the fund and are immediately getting, I guess, interest in the overall fund, correct?
That's right. So if we make the math easy, let's say it's a $10 million fund, an investor gives us $1 million, like they own 10% of the underlying fund. So they get 10% of the cash flow from the jump. And then we've got that then $1 million to then go out and deploy and buy houses with.
And what is Scholastic Capital's overall goal in terms of, I guess, fund size or number of units? Do you guys have goals? I'm assuming you do.
We do. So because we want to do that, we want to sell the portfolio down the line. We really need to get to a minimum of 100 houses. That's the threshold where somebody serious would start taking a look at the portfolio. At 250 homes, they would be pretty interested. And at 500 homes, they would be like very interested. So we need to get to at least 100. 250 would be better. Like 500 is best case scenario.
And you said you're buying on average 4 homes a month right now?
Yep, that's about right. And average home right now is worth about 520 grand. So 500 homes would be about $250 million worth of real estate is kind of the ideal threshold to get up to.
So I'm going to ask you this question because it's kind of a hot topic for people listening to this in the future. Mm-hmm. We are recording this in October of 2024. So just keep that in mind. Home prices have been all over the news over the last, 3, 4, 5, 6 years, going through the roof. Everything's more expensive. Clearly, this model is still working for you in your markets. Why do you think you're able to continue to run this model when home prices across the country are up crazy amount right now?
It's a good question. The way that we think about it is the way it works is accessibility. So for the vast majority of our tenants, they're interested in moving into the zip code, typically for high school. And then once the kids are out of the house, the parents are empty nesters, parents move to Florida or somewhere else. So for that reason, if you're looking to move into one of these really good school districts for 4 years or 6 years for multiple kids, and your choices are pay $3,600 a month in rent or buy a house for $1 million, jumbo loan, 250 grand down payment at a minimum, plus you're going to have transaction costs when you try to sell it 4 or 6 years later, you're probably going to lose money. Like in most cases, the renting makes more sense for just about everybody to do. And our 2 most common jobs out of our tenants are software engineer and doctor. So they're doing the math. They're smart folks. They're looking at it and be like, hey, if I have those choices, like renting is the smarter choice for me to do. As long as that buy versus rent math continues to hold, like we should theoretically be well positioned for those tenants who are here for a short period of time, but a short but kind of defined period of time.
And have your yield to cost numbers been squeezed at all with rates being where they're at? Or are you, I guess, buying rates down or doing anything in addition to just conditional or normal financing to make numbers work? Or are you just leaving them how they are?
Because we're buying enough, we have, for lack of better words, like negotiated better terms with lenders because they're getting a lot of work from us. So our weighted average interest rate right now in the portfolio is 6.15, and the average 30-year fixed right now is about 7 and change. 7.02 is what I saw the print was this morning. So we are getting much better rates just because we're buying in bulk.
Okay, so if let's say, because a lot of people are talking in 2026, rates should be in the mid 5s. Is there any, I guess, scenario where you would go look at doing a bulk refinance and getting more cash into the fund?
There is. We absolutely would do that if rates make sense to do. The challenge is we've seen some other funds that have like promised their investors, like, we're going to do this, we're definitely going to refinance. And like, we don't want to make that promise because like it's kind of out of our control on if rates do get to that point. But if they do, we're absolutely going to try to do that just to refresh lower rates and see if we can bring some money out either to then give it back to our investors or go buy more homes with.
Yeah. And as an investor in your fund, what are they looking at? What are the returns that they're able to achieve?
Yep. So our total forecasted return is 15.1% IRR. And they get there via the distribution. So we send out distributions monthly on the cash flow. And then the investor also owns the underlying equity. So as we pay off the mortgage, as the homes appreciate, as we sell them down the line, like they'll get their equity as well.
And is there a preferred return at all?
There is. So we have an 8% preferred return. So investors get 100% of everything until they've made 8% of their money. And then after the 8%, it's a 80-20 split. So they get 80 cents on the dollar and we get 20 cents on the dollar.
Very nice. And then last question I have, just because I'm curious and want to know more about your business here. What are the new homes that you're buying looking like? Are they drastically different in terms of metrics from the house that we talked about in Illinois from 2 years ago? Is it more of the same? What does your current additions and acquisitions look like right now?
They're roughly the same. We've made one change over the past week or so that we're now actually screening for is a fence in the backyard. It's the number one most requested thing that we get is like, hey, everybody got a dog during COVID. I need a fence for the house. I don't want to walk the dog outside in the Chicago and Wisconsin winters. So that's been the big change actually, is we prefer homes with fences, or if it doesn't have a fence, we add on like $3,000 in our budget, assuming that we're going to have to put a fence on the house. Outside of that, acquisitions are largely similar. We're just getting better at them. Like we collect a lot of data. I've got the serial number of every fridge. I've got the serial number of every water heater across all of it. Like we need to collect that data to get smart about our forecasting and our budgeting. So we're getting better at the acquisition process, but it is more of the same.
Very nice. And Sean, where can people hear more from you or connect with you?
So our website, scholasticcapital.com. And then I'm pretty active on Twitter. I share like a kind of a running daily monologue of like what we're thinking about, what we're doing, what we're seeing. So at Sean O'Dowd 15, I'm the 15th Irish guy. No Sean apparently, but I'm Sean O'Dowd 15 on Twitter.
Very nice. We'll make sure those are all linked below. Sean, thank you so much for sharing about Scholastic Capital, your single family investment portfolio. And I don't think we've ever heard someone focus specifically on high-end school districts as a fund model. So that was very cool to hear.
Well, I appreciate it. Thanks so much for having me.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.